There's a six-stage pattern that has destroyed the British pound at least 3 times in the last century. Each time, the warning signs were visible years in advance. Each time, every economist, politician, and central banker swore it couldn't happen. And each time, it happened faster than the last. And right now, in 2025, the United Kingdom is quietly moving through those same 6 stages again. The pound has lost more than 74% of its value against the dollar since the pattern first appeared. The national debt has crossed 100% of GDP, and the political class is repeating the exact same mistakes that triggered every previous collapse. Only this time, the global financial system is more fragile than it has ever been. In 1931, Britain clung to the gold standard, while unemployment soared past 2.5 million and gold drained out of the Bank of England at a terrifying rate. It took 6 years of slow bleeding before the pound collapsed 33% in a single month. In 1976, runaway inflation hit 25%. The Prime Minister resigned mid-crisis, and Britain became the first major Western economy to beg the International Monetary Fund for a bailout, and the slide took roughly 4 years from trigger to humiliation. Then, in 1992, the pound was destroyed in a single day. One hedge fund manager bet $1 billion against the Bank of England. Interest rates were hiked 3 times in 12 hours, and by nightfall the entire policy was dead. 6 years, 4 years, 1 day. The pattern isn't just repeating, it's compressing. And here's what should concern you. The United Kingdom in 2025 has already completed 4 of the 6 stages in this sequence. The warning signs that preceded every previous sterling crisis, the debt levels, the political dysfunction, the loss of market confidence, they aren't just present. They're worse than they've ever been. This is the story of how the same 6-stage pattern destroyed the most powerful currency on Earth 3 times in 60 years, and how it's setting up to do it again. We'll trace the exact mechanism from overconfidence to collapse, show you where Britain is right now in the sequence, and explain what the final 2 stages look like when they arrive, because the pattern says they will. Every sterling crisis in the last century has followed the same 6-stage sequence. Here's how it works. A government locks the pound to an external anchor, gold, another currency, or a fixed exchange rate mechanism, at a rate that doesn't reflect economic reality. The mismatch creates invisible pressure that builds for years. To maintain the illusion, governments spend beyond their means, central banks print or borrow to cover the gap, and inflation or deflation spirals in whichever direction the peg distorts. The real economy diverges from the official exchange rate. The corrections needed to maintain the peg, spending cuts, interest rate hikes, wage reductions, become politically impossible. Governments split, prime ministers resign, coalitions fracture. The policy response stalls at the worst possible moment. Foreign investors and central banks begin pulling capital. External crises, banking panics, trade wars, geopolitical shocks accelerate the drain. The central bank's reserves begin disappearing at an alarming rate. Speculators, sensing blood, mount a coordinated attack on the currency. The central bank's defenses, rate hikes, foreign credit lines, market intervention, fail one after another. The peg breaks. The pound devalues violently. The government is forced into humiliating concessions, bailouts, austerity, or wholesale policy reversal, and the economic damage radiates outward for years. 6 stages, same order, every single time. Let's start with the crisis that set the template. In April 1925, Chancellor of the Exchequer Winston Churchill made what he would later call the greatest mistake of his career. He returned Britain to the gold standard at the pre-war parity of $4.86 to the pound. On paper, it was a statement of imperial confidence. Britain was declaring that the pound was as strong as it had been before the First World War. In reality, it was a lie. The Great War had fundamentally altered Britain's economic position. 4 years of industrial warfare had drained the treasury, inflated wages and prices, and shifted the global center of financial gravity from London to New York. British goods were now significantly more expensive than American goods at the old exchange rate. The pound at $4.86 wasn't a reflection of strength. It was a monument to nostalgia. John Maynard Keynes warned against it publicly, arguing in his 1925 pamphlet The Economic Consequences of Mr. Churchill that the overvaluation would force a brutal deflation on British workers and exporters. He was ignored. The City of London wanted the old parity. The Bank of England's Governor Montague Norman wanted the old parity. The prestige of sterling demanded the old parity. And so the pound was locked to gold at a rate that required British prices to fall by roughly 10% to become competitive, a deflation that would have to come from cutting wages, laying off workers, and suppressing domestic demand. The clock had started. Britain had strapped itself to an artificial peg, and it would take 6 years for the pressure to blow the system apart. This is the first stage of every sterling crisis, the moment a government fixes the currency at a rate that doesn't match reality and then defends it with ideology rather than economics. In 1925, the mismatch was stark. British export prices were roughly 10 to 15% higher than they should have been, making coal, textiles, and manufactured goods uncompetitive on world markets. The result was immediate. Export volumes stagnated, industrial regions hemorrhaged jobs, and the coal industry, Britain's largest employer, spiraled into crisis, culminating in the general strike of 1926. Montague Norman, the enigmatic and stubborn governor of the Bank of England, held the line. He kept interest rates elevated to attract foreign capital and maintain gold reserves, even as that policy strangled domestic industry. Between 1925 and 1929, Britain's economy barely grew while America boomed. The gap between the pound's official value and its real purchasing power widened year by year. This alone doesn't cause collapse. Countries can maintain overvalued currencies for years if they have the reserves and the political will. But this stage creates the structural fault line. Every future shock hits harder because the foundation is already cracked. And in 1929, the shocks began. The Wall Street crash of October 1929 sent tremors through every connected economy. But Britain was uniquely vulnerable. The government's fiscal position had been deteriorating for years. Tax revenues fell as unemployment climbed past 1 million, then 1.5 million, then 2 million by 1930. Spending on unemployment insurance, the dole, ballooned. The budget, which had been roughly balanced in the mid-1920s, swung into deficit. The Bank of England faced an impossible choice. Raising interest rates would defend the gold peg but deepen the recession. Lowering them would ease domestic pressure but invite gold outflows. Norman chose a middle path that satisfied no one. Modest rate adjustments paired with quiet interventions in the foreign exchange market, burning through reserves to buy time. Here's what people don't understand about this stage. It isn't about a single bad decision. It's about the accumulation of small compromises that each make sense individually, but collectively create a position that cannot be defended. By 1930, Britain was simultaneously trying to maintain an overvalued currency, fund a growing welfare state, service its war debts, and keep interest rates high enough to retain foreign capital. The math didn't work, but admitting that meant admitting the gold standard was a mistake, and nobody was willing to do that. By the summer of 1931, unemployment had passed 2.5 million. The May Committee, appointed by Labour Chancellor Philip Snowdon, delivered its report in July. Its recommendation was brutal: slash unemployment benefits by 20%, cut government salaries, raise taxes. For a Labour government that existed to protect workers, this was political suicide. Prime Minister Ramsay MacDonald was trapped. His own cabinet split almost evenly. 11 ministers backed the cuts, 9 opposed them. The Trades Union Congress rejected any benefit reductions outright. On August 23, 1931, MacDonald resigned, only to re-emerge the next day at the head of a national government coalition with Conservative and Liberal support, a move his own Labour Party would never forgive. branding him a traitor. This is the point of no return, not because the economics were irreversible. They might have been managed with decisive action weeks earlier. But because this stage removes the possibility of decisive action, the political system fragments precisely when unity is most needed. MacDonald's new coalition had a mandate to cut, but its legitimacy was hollow. Markets saw a government that had broken apart under pressure, and they drew the obvious conclusion: if the politicians couldn't hold together, neither could the pound. The external shocks came in waves. In May 1931, Austria's largest bank, Credit Anstalt, collapsed, sending panic across Central European financial markets. By June, Germany's banking system was in freefall. A standstill agreement froze roughly £70 million of British bank deposits in Germany, money that was simply gone. The contagion hit London like a blast wave. From July 13 onward, the Bank of England hemorrhaged gold and foreign exchange at a pace that stunned even Norman. £50 million in reserves vanished in 6 weeks, the equivalent of 1.5 months' worth of total British exports simply evaporating into foreign hands. French and American banks, sensing the weakness, pulled their short-term deposits from London. The Bank of France, which had been quietly accumulating gold at Britain's expense for years, accelerated its withdrawals. Norman arranged emergency credit lines, £25 million from the Federal Reserve, £25 million from the Bank of France. The money arrived in August. It was gone by early September. The reserves that were supposed to last months had been consumed in weeks. Now watch what happens next. The speculators hadn't even arrived yet. The reserves were being drained by ordinary capital flight, banks and governments simply moving their money to safety. The coordinated assault was still coming. The Bank of England was losing the war before the battle had even begun. By early September 1931, the foreign exchange market had reached its own conclusion. The pound could not hold. Traders and foreign central banks began selling sterling in volumes the Bank of England could not absorb. Norman raised the bank rate to 4.5% on July 23, then to 6% on September 10. It made no difference. The selling intensified. The Bank of England attempted forward interventions, promising to buy sterling at future dates to signal confidence. The market ignored them. Every defense mechanism the bank deployed was overwhelmed within days. The fire hose couldn't keep up with the inferno. Sterling fell against the dollar and the French franc simultaneously. By mid-September, the bank's reserves were effectively exhausted. On September 19, 1931, Britain suspended gold convertibility. The pound, which had been pegged at $4.86 for 6 years, immediately plunged. Within weeks it had fallen to $3.69, a devaluation of 33%. The gold standard, which Britain had championed as the bedrock of global financial stability, was dead. The aftermath was paradoxical. Freed from the golden straitjacket, British exports became competitive again. Industrial production began recovering within months. Interest rates fell. By 1933, Britain was growing faster than almost any major economy. But the human cost had already been paid. Unemployment in mining regions exceeded 20%. Real wages had been crushed by years of deflation. The political system had been permanently scarred. MacDonald's betrayal split the labor movement for a generation, and the pound never returned to $4.86 again. It never even came close. The lesson of 1931 is this: an artificial peg, defended past the point of reason, doesn't prevent collapse. It guarantees that when collapse arrives, it's catastrophic rather than manageable. Britain endured 6 years of unnecessary economic pain to maintain a fiction, and the fiction died anyway. The only winners were the countries that abandoned gold early. The only losers were the workers and businesses who bore the cost of defending a number on a ledger that had nothing to do with the real economy. Let's jump forward 45 years to an era when the gold standard was a memory, the British Empire was gone, and the pound had already been devalued twice, in 1949 and again in 1967. By the mid-1970s, Britain was no longer the world's banker. It was struggling to remain a first-tier economy. And the pattern played out again. Same 6 stages, same political denial, same market verdict. But this time it happened in 4 years instead of 6, and it ended not with a devaluation, but with something arguably more humiliating. By 1972, the British pound was a shadow of its former self. The Bretton Woods system had collapsed the year before, severing the dollar's link to gold and floating most major currencies. Sterling had already suffered a traumatic 14% devaluation in 1967 under Harold Wilson, who famously assured the public that the pound in your pocket was unaffected. A statement so misleading it became a national punchline. Britain had briefly joined the European currency snake in 1972 and been forced out within weeks. The country was caught between two eras. The imperial economy was dead. The captive markets of the Commonwealth were gone. North Sea oil was still years from flowing, and British manufacturing was being steadily overtaken by West Germany and Japan. But the welfare state built in the post-war decades, the National Health Service, universal unemployment insurance, council housing, demanded ever-increasing public spending. Something had to give. What gave in the end was fiscal discipline. In 1972, Chancellor Anthony Barber delivered a budget that slashed taxes and unleashed government spending in a bid to jolt the economy out of stagnation. The Barber boom worked briefly. GDP surged, consumption soared, property prices doubled. But Barber had lit a fuse. By the time the boom turned to bust in 1973, coinciding with the OPEC oil embargo that quadrupled energy prices overnight, inflation was already running out of control. Britain was entering the next stage of the sterling crisis pattern, with no reserves, no peg to anchor expectations, and a political class that was about to tear itself apart. Rather than a formal gold standard, Britain maintained an implicit commitment to defend sterling's value against the dollar, a psychological peg born of post-war pride and the pound's lingering role as a reserve currency. The Treasury and Bank of England intervened regularly in forex markets to prevent sterling from falling below levels they considered acceptable, even as the underlying economy deteriorated. This informal defense was in some ways more dangerous than the explicit gold peg of 1925. Because it was never formally declared, there was no public debate about whether the target rate was realistic. Governments could deny they were defending any particular level, while spending billions doing exactly that. The Bank of England's forex reserves were treated as a war chest for an undeclared war, one that consumed resources without any clear victory condition. By 1974, after the oil shock had torn through the current account and inflation was accelerating toward double digits, the implicit peg was already untenable. But admitting that, letting the pound float to its natural, much lower level, would have meant admitting that Britain's economic standing had permanently diminished. And no politician was willing to say that out loud. Anthony Barber's 1972 budget had blown the spending gates wide open, and his successors couldn't close them. The Conservatives under Edward Heath tried to impose wage controls to contain inflation, and were destroyed by the miners' strike of 1974, losing power to Harold Wilson's Labour Party in 2 bruising elections that year. Labour inherited an economy in freefall. Inflation, which had been 7% in 1972, hit 16% in 1974, and then an astonishing 25% in 1975, the highest rate in any major Western economy. The wage price spiral was vicious. Unions demanded raises to match inflation, employers raised prices to cover wage costs, and inflation climbed further. Government borrowing exploded as tax revenues failed to keep pace with spending commitments. But here's where it gets darker. The inflationary spiral wasn't just eroding living standards. It was destroying the pound's credibility in international markets. Foreign holders of sterling-denominated assets watched their real returns evaporate. Central banks that had historically held pounds as reserves began quietly diversifying. Every month of 25% inflation was a month in which the world's confidence in sterling died a little more. The political paralysis that had fractured MacDonald's cabinet in 1931 now consumed the Labour government of the mid-1970s. In March 1976, a public spending white paper, the government's plan to rein in the deficit, was defeated in Parliament. Labour didn't have a working majority, and its own left wing refused to support cuts to social programmes. The fiscal consolidation that markets demanded was legislatively impossible. Then the political system cracked wide open. Harold Wilson, exhausted and privately battling health concerns, resigned as Prime Minister on March 16, 1976. His departure stunned markets. James Callaghan won the subsequent leadership contest, but the transition took weeks during which Britain effectively had no functioning economic policy. The Bank of England, unsure what the new government's priorities would be, paused its foreign exchange interventions. Currency markets are built on confidence, and confidence is built on predictability. A country whose parliament rejects its own budget, whose prime minister resigns without warning, and whose central bank stops defending the currency, is a country that has entered this stage in its most acute form. The pound began falling almost immediately. Between March and June 1976, sterling dropped to record lows against the dollar. The slide had become a plunge. The reserve drain that had taken months in 1931 now accelerated to weeks. With the Bank of England's forex intervention paused and political leadership in transition, foreign holders of sterling began liquidating their positions en masse. Oil-producing nations that had accumulated large sterling balances after the 1973 price spike, particularly Nigeria and several Gulf states, started converting pounds to dollars. The contagion dynamics were different from 1931. There was no single credit-anstalt moment, but the effect was the same. Britain's reserves shrank visibly, and every published figure showing the decline triggered another wave of selling. The International Monetary Fund began private conversations with the Treasury in the spring of 1976, but the political sensitivity was enormous. Britain, a founding member of the IMF and a permanent member of the United Nations Security Council, was being treated like a developing country that had mismanaged its finances, which, by any objective measure, it had. By the autumn of 1976, the foreign exchange market had turned hostile. The pound, which had been worth $2 as recently as early 1976, fell below $1.60 by October, a decline of 36% against the dollar in barely 7 months, or 23% on a trade-weighted basis. Denis Healey, Callaghan's chancellor, was literally on his way to the airport for an IMF meeting in Manila when the pound cratered so sharply he turned around and returned to the Treasury. That image, a Chancellor of the Exchequer unable to leave the country because the currency was collapsing, captured the humiliation of this stage. Denis Healey turned around at Heathrow Airport because the pound was falling so fast he couldn't risk being on a plane when the next number came in. That's not a government managing a crisis. That's a government being managed by one. The Bank of England raised the minimum lending rate to 15%, the highest in Britain's post-war history. It barely slowed the selling. Foreign exchange dealers were openly betting against sterling, and every rate hike simply confirmed their thesis. A country that has to offer 15% interest to hold its currency is a country that has already lost. On December 3, 1976, Denis Healey stood before Parliament and announced that Britain had formally requested a loan from the International Monetary Fund. The amount was $3.9 billion, the largest loan the IMF had ever made, equivalent to roughly £21.6 billion in 2024 terms. The conditions were savage: deep cuts to public spending, reductions in the public sector borrowing requirement, and implicit supervision of British fiscal policy by IMF technocrats in Washington. For a nation that had, within living memory, governed a quarter of the world's population, the humiliation was existential. The Times called it the day the pound died. Callaghan, in a remarkably candid speech to Labour's party conference that September, had already delivered the post-mortem. We used to think you could spend your way out of a recession. I tell you in all candor that that option no longer exists. The pound stabilized around $1.70, but the damage ran far deeper than the exchange rate. The 1976 crisis marked the end of the post-war Keynesian consensus in British economic policy. It opened the door to Margaret Thatcher's monetarist revolution in 1979. And it took barely 4 years from trigger to collapse, almost half the time of the 1931 crisis. The pattern was accelerating. 6 years in 1931, 4 years in 1976. But the third time the pattern appeared, it would compress even further, from years to months, and ultimately to a single catastrophic day. Let's move forward to 1992, to a moment when the British government staked its entire economic credibility on a fixed exchange rate, and a single investor proved, in 12 hours, that the pattern always wins. History was about to repeat, but faster than anyone imagined possible. In October 1990, Prime Minister John Major, then serving as Chancellor under Margaret Thatcher, took Britain into the European Exchange Rate Mechanism, the ERM. It was supposed to be the anchor that the pound had been searching for since the gold standard era. By locking sterling to the German Deutschmark at a central rate of 2.95 marks per pound, within a narrow fluctuation band, Britain would import German monetary credibility. Inflation would fall. Interest rates would stabilize. Investment would flow in. The logic was elegant. The timing was catastrophic. Britain joined the ERM at the tail end of an unsustainable property and credit boom, the Lawson boom, that had already turned to bust. The economy was contracting. Unemployment was rising. House prices were falling, and the exchange rate at which Britain entered, 2.95 Deutschmarks, was widely regarded as too high, just as $4.86 had been too high in 1925. Major, who became Prime Minister in November 1990, made ERM membership the centerpiece of his economic policy. He called sterling's membership of the ERM the cornerstone of his government's anti-inflation strategy. His Chancellor, Norman Lamont, went further, pledging to defend the parity with whatever it takes. These were not casual commitments. The government's entire credibility was staked on a number, 2.95 marks per pound, that had been chosen for political reasons at the wrong moment in the economic cycle, in a system that left Britain no room to maneuver. The first stage was set. The artificial peg was locked in place, and the clock was already ticking. The ERM peg replicated the fundamental error of 1925 and the implicit defense of the mid-1970s, but in a more rigid form. The fluctuation band allowed only a 6% deviation from the central rate. If sterling approached the floor of the band, the Bank of England was obligated to intervene, buying pounds, selling foreign currency, raising interest rates, regardless of domestic economic conditions. Britain had voluntarily surrendered its ability to set monetary policy according to its own needs. Interest rates would be determined not by what the British economy required, but by what was needed to keep the pound above 2.77 Deutschmarks. In a booming economy, that might have been manageable. In a recession, it was a straitjacket. To defend the ERM parity, the Bank of England maintained interest rates at 10%, even as the economy contracted and unemployment climbed past 2.5 million. Mortgage holders were being crushed. Businesses were going bankrupt at record rates. The housing market had lost a quarter of its value from the 1989 peak. The fundamental problem was that Germany and Britain were in opposite economic phases. Germany, absorbing the costs of reunification after 1990, was raising interest rates to contain inflationary pressure. Britain, mired in recession, desperately needed to cut rates. But the ERM peg meant British rates had to shadow German rates, regardless of British conditions. The Bank of England was essentially running German monetary policy in a British recession. The overreach wasn't spending too much, it was charging too much for money when the economy was already suffocating. The political paralysis of 1992 was perhaps the most self-inflicted of all three crises. John Major had personally championed ERM entry. His government's credibility, and his own, was completely identified with the peg. Abandoning it would mean admitting that the centerpiece of his economic strategy had been wrong from the beginning. Major's cabinet was divided between Eurosceptics who had always opposed ERM membership and loyalists who backed the Prime Minister. But the divisions were suppressed rather than resolved. There was no contingency plan for exit, no scenario planning for failure. The government's entire strategy was built on the assumption that the markets would not challenge a commitment backed by the fifth largest economy in the world. This was not just paralysis, it was willful blindness. While the Treasury maintained its public confidence, traders in London, New York, and Frankfurt were doing the math, and the math said the peg couldn't hold. The contagion trigger came from an unexpected direction. In June 1992, Denmark voted to reject the Maastricht Treaty in a referendum, throwing the entire European monetary project into doubt. If one country could vote against deeper integration, the political foundations of the ERM and the planned single currency were suddenly fragile. Markets immediately began testing the weaker ERM currencies, the Italian lira, the Spanish peseta, and sterling. Through the summer of 1992, the Bank of England spent billions in reserves, buying pounds on the open market to keep sterling within its ERM band. Each intervention brought a few days of stability, followed by renewed selling pressure. The lira broke first. Italy devalued on September 13th, removing one of sterling's companion currencies from the mechanism. Britain was now exposed, and every trader in the world knew it. The reserve drain that had taken 6 weeks in 1931 and several months in 1976 was now measured in days. September 16, 1992. Black Wednesday. The day the pattern completed at maximum speed. George Soros, the Hungarian-born hedge fund manager running the Quantum Fund from New York, had been building a massive short position against sterling for weeks. His thesis was simple and devastating. Britain could not simultaneously maintain the ERM peg and avoid economic catastrophe. The peg had to break. He bet $10 billion on it. At 7 in the morning, the Bank of England began buying pounds. By mid-morning, the selling pressure was overwhelming. Chancellor Norman Lamont authorized an emergency rate hike from 10% to 12% at 11 in the morning. The announcement, intended to signal resolve, had the opposite effect. Traders interpreted it as panic. The selling intensified. Sterling continued to fall. At 2:15 in the afternoon, Lamont authorized a second rate hike to 15%. This was an act of desperation that bordered on the absurd. No economy in recession can sustain 15% interest rates. The market knew it was a bluff. Sterling didn't even pause. Here's what nobody tells you about Black Wednesday. The 15% interest rate was never real. It was announced at 2:15 in the afternoon and reversed before markets opened the next morning. It existed for approximately 17 hours, most of them overnight. The Bank of England bluffed with a number so absurd that the market didn't even flinch. They raised rates by 50% in a single afternoon, and the pound kept falling. The Bank of England spent an estimated £3.3 billion in reserves on September 16 alone, buying a currency that the market had already condemned. By 7:30 in the evening, it was over. Lamont appeared outside the Treasury and announced that Britain was suspending its membership of the exchange rate mechanism. The 15% rate was quietly reversed before it took effect. The 12% rate was reversed the next morning. In a single day, the Bank of England had been defeated. George Soros made approximately $1 billion in profit. Norman Lamont's career was destroyed, and the pound, freed from the ERM, immediately fell to 2.40 Deutschmarks, a decline of nearly 20% from its central rate. The aftermath of Black Wednesday was, like 1931, paradoxically beneficial for the real economy. Freed from the obligation to maintain punitive interest rates, the Bank of England cut rates aggressively. The economy began recovering within months. Exports surged. The housing market slowly stabilized. By 1990, Britain was growing faster than Germany or France. But the political damage was terminal. John Major's government never recovered its economic credibility. The Conservative Party, which had entered the ERM with triumphant confidence, was branded the party of economic incompetence, a reputation that helped keep it out of power until 2010. The cost to taxpayers of Black Wednesday was estimated at £3.3 billion, though the long-term costs of maintaining the peg would have been far higher. Let me show you what that acceleration actually looked like. 1931, 6 years from peg to collapse. 1976, 4 years from Barber's budget to IMF bailout. 1992, 23 months from ERM entry to Black Wednesday. Plot those on a chart and the curve doesn't flatten, it steepens. Each crisis teaches the market how to strike faster. 3 crises, 3 collapses, 3 identical 6-stage patterns, and each one faster than the last. The question isn't whether the pattern exists, that's documented history. The question is whether it's happening again. Because when you look at the United Kingdom in 2025 and hold it up against those 6 stages, the comparison isn't just uncomfortable, it's alarming. Let me show you what that actually looks like. Now let's talk about Britain in 2025. 3 times in 61 years, the same 6-stage pattern destroyed the pound's value and humiliated the government of the day. Each time, the crisis arrived faster than the last. Each time, the warning signs were ignored until they became emergencies. And every single stage of that pattern is visible right now, not in some distant theoretical future, but in the data that's being published today. We're in the 4th stage. 4 of 6 stages are complete. The reserve hemorrhage and loss of international confidence that preceded every previous collapse has already begun. Here's the stage-by-stage comparison. Britain no longer maintains a formal exchange rate peg. Sterling has floated freely since 1992. But the modern equivalent of the artificial peg is something more insidious. The implicit assumption, embedded in government policy, that the pound will maintain its purchasing power through central bank credibility alone. The Bank of England's 2% inflation target functions as a soft peg, a promise that sterling's value will erode at a controlled, predictable rate. When that promise breaks, as it did spectacularly in 2022 and 2023, when inflation hit 11.1%, the credibility anchor dissolves, and sterling behaves exactly as it did when formal pegs collapsed. The artificial constraint on monetary policy isn't a gold price or an exchange rate band anymore. It's a credibility framework, and that framework has cracked. Check. The fiscal numbers are staggering by any historical comparison. United Kingdom public debt has crossed 100% of GDP for the first time since the aftermath of the Second World War. Annual borrowing remains well above pre-pandemic norms. The Office for Budget Responsibility has warned repeatedly that current fiscal trajectories are unsustainable without either significant tax increases or spending cuts, neither of which is politically deliverable. On the monetary side, the Bank of England's balance sheet exploded during the pandemic-era quantitative easing program, absorbing hundreds of billions of pounds in government gilts. The bank is now unwinding those positions, quantitative tightening, into a market that is increasingly nervous about absorbing the supply. Just as the 25% inflation of the 1970s eroded sterling's credibility from within, the combination of persistent deficits, high debt, and a central bank selling bonds into a weak market is creating structural fragility that markets are beginning to price. Czech Britain has cycled through 5 prime ministers since 2016. 5. In the same period, Germany has had 2 chancellors, and the United States has had 3 presidents. The political instability is not a temporary aberration. It reflects a structural inability to build consensus around any coherent economic strategy. Brexit consumed the political system for 4 years and left deep divisions that still shape every policy debate. The Conservative Party tore itself apart over Europe, then over leadership, then over economic policy during the catastrophic Liz Truss premiership of 2022. Labour, returned to power, faces its own fiscal straitjacket, promises of public investment constrained by borrowing limits that leave almost no room for manoeuvre. The Office for Budget Responsibility, the Bank of England, and the Treasury are pulling in different directions. The corrections needed, whether to raise taxes, cut spending, or reform the economy's supply side, are politically impossible for the same reason they were impossible in 1931, 1976, and 1992. They would hurt the people who vote. Check. This is where we are right now. The modern equivalent of reserve hemorrhage isn't gold flowing out of the Bank of England's vaults. It's foreign investors losing confidence in United Kingdom government debt. In September 2022, the mini-budget crisis provided a preview of what this stage looks like in the modern era. When Chancellor Kwasi Kwarteng announced £45 billion in unfunded tax cuts, the gilt market, the market for British government bonds, didn't just decline. It collapsed. Pension funds faced margin calls. The Bank of England was forced to intervene with an emergency £65 billion bond buying programme to prevent a systemic financial crisis. Here's what should concern you about September 2022. It wasn't a crisis caused by external shocks, or global contagion, or a world war. It was caused by a single budget announcement by a British Chancellor. The system is now so fragile that a domestic policy error, not a global catastrophe, can trigger a near collapse. The margin for error is effectively zero. That episode lasted days, not months. It was contained, but it revealed something that every previous sterling crisis also revealed at this stage. The margin of safety is gone. One policy mistake, one external shock, one loss of market confidence, and the system comes under immediate, potentially uncontrollable pressure. The buffer has been consumed. We're here now. The coordinated market assault hasn't arrived yet, but the preconditions are all in place. The hedge fund industry is larger, faster, and more globally connected than at any point in history. The algorithmic trading systems that dominate modern forex markets can execute sell orders in milliseconds. The concentrated short positions that Soros built over weeks in 1992 can now be assembled in hours. The early warning signs are visible. Sterling volatility measures have been elevated since 2022. Options market pricing suggests traders are paying increasingly high premiums to hedge against sharp pound declines. The smart money isn't attacking yet, but it's positioning. Just as the selling in 1931 started with routine capital flight before the speculators arrived, the early-stage positioning in 2025 is the precursor, not the main event. What does the final stage look like in the modern context? It looks like a sudden, disorderly sterling decline, not the 33% of 1931 or the single-day humiliation of Black Wednesday, but a fall sharp enough to force emergency policy responses. It could mean emergency rate hikes that crush an already weak housing market. It could mean an unplanned fiscal consolidation, austerity imposed not by choice, but by market force. In the worst case, it could mean something no British government has faced since the humiliation of the 1976 IMF bailout, going back to the International Monetary Fund. The pattern doesn't care about national pride, it cares about math. But the evidence doesn't stop with the six-stage framework. Consider the broader picture. Britain's current account deficit, the gap between what the country earns from the world and what it pays, has been persistently negative for decades, meaning Britain depends on continuous foreign capital inflows to finance its consumption. Any disruption to those inflows triggers immediate pressure on the pound. But the evidence doesn't stop there. A 45-day premiership nearly broke the bond market. That sentence should be extraordinary. In any previous era, it would have been unthinkable. In 2022, it happened. Liz Truss served fewer days as Prime Minister than a typical lettuce lasts on a supermarket shelf, and in that time, she nearly triggered the fifth stage. United Kingdom inflation peaked at 11.1% in October 2022, the highest in 41 years, approaching, in relative terms, the kind of inflationary shock that preceded the 1976 crisis. Real wages fell for the longest sustained period since records began. Productivity growth has flatlined since the 2008 financial crisis. GDP per capita has barely moved in 15 years. And then there's the structural factor that makes 2025 different from every previous crisis. Britain is no longer a member of the European Union. The trade frictions, regulatory barriers, and reduced labour mobility created by Brexit have permanently diminished the economy's growth potential, a fact acknowledged by the Office for Budget Responsibility, the Bank of England, and virtually every independent economic forecaster. The signs are everywhere. The question is whether anyone is willing to read them. If the pattern holds, and it has held for nearly a century, here's what the remaining stages look like. The market assault arrives when a trigger event shatters whatever residual confidence remains. It could be a failed gilt auction where the government tries to sell bonds and finds insufficient demand. It could be a geopolitical shock, a trade war escalation, a European banking crisis, a conflict that disrupts energy supplies. It could be something as mundane as a single month of unexpectedly bad inflation data that convinces markets the Bank of England has lost control. When it hits, the speed will be terrifying. In 1931, the market assault played out over weeks. In 1992, it took a single day. In the age of algorithmic trading, high-frequency forex markets, and globally connected hedge funds, it could compress into hours. The Bank of England's ability to defend sterling would be tested not by human traders making phone calls, but by automated systems executing billions of pounds in sell orders per second. Capitulation would force the government into emergency measures with no good options. Raise interest rates sharply to defend the pound. That crashes the housing market, where the average mortgage holder is already stretched to breaking point. Let the pound fall? That imports inflation through higher energy and food costs, hammering the poorest households hardest. Seek external support? The political humiliation of another IMF approach would be career-ending for any chancellor, and potentially government-ending for any party. For ordinary people, the impact would be felt within days. A falling pound means more expensive petrol, higher grocery bills, costlier foreign holidays, and imported goods. For anyone with a variable rate mortgage, emergency rate hikes mean hundreds of pounds per month in additional payments. For businesses that import materials, margins evaporate overnight. The pattern doesn't discriminate. It hits everyone. 3 times the same pattern has destroyed the pound. In 1931, Britain clung to an overvalued gold standard for 6 years before the market forced the 33% collapse. In 1976, 4 years of inflationary spiral led to the humiliation of the largest IMF bailout in history. In 1992, Soros's billion-dollar bet against Britain dismantled the ERM peg in a single day. 6 years, 4 years, 1 day. That's not a random sequence. That's acceleration. Each crisis compresses the timeline because each crisis teaches the market how to attack faster. The speculators of 1992 had studied 1976. The algorithms of 2025 have studied all 3. The playbook is public. The vulnerabilities are known. The defenses are weaker than they've ever been. The pound has fallen from $4.86 in 1925 to roughly $1.25 today, a decline of more than 74% across a century. That decline hasn't been smooth. It's come in violent, sudden collapses, each one following the same 6-stage pattern, each one arriving faster than the last. We're not just repeating the pattern, we're accelerating it. And the next collapse, if it comes, won't take 6 years or 4 years or even 1 day. In the age of algorithmic trading and instant capital flows, it could be measured in hours. Maybe this time is different. Maybe Britain can thread the needle, reduce debt without austerity, restore growth without inflation, rebuild market confidence without a crisis to force its hand. Maybe the pattern that has held for a century will finally break. But the math says otherwise. The debt says otherwise. The political dysfunction says otherwise. And every trader, every hedge fund manager, every algorithm scanning the forex market for weakness, they've read this history too. They know the 6 stages. They know where Britain is in the sequence, and they're waiting. If this video opened your eyes to where Britain actually is in this pattern, subscribe. Because when the next stage arrives, and the pattern says it will, you'll want to understand what's happening and why. Before the headline